Hello, I'm Adam from Market Life, and welcome to the free video for Friday, February 28th, 2020. So rather than talking about a trade setup right now, one reason is with the market under so much stress, you see the SPY, the spiders on the screen, there's really not a lot of trade setups for swing traders. There are things for short-term traders to do. Swing traders should be taking profits on shorts. But rather than talking about a trade setup, I want to share a snippet from our trading room today where we talked about a trade we put on in the SPY and talked about the whys and the specifics. It's a little bit of a complex option structure, but not terribly complicated. But it's an interesting trade because it's a trade where really we were risking time decay. It was a bearish trade where we ended up taking it off at the end of the day, making over $800 on it. Had the market rallied strongly against us, we would not have lost money. So we did not really have any risk on price movement. Our risk was time. Our risk was if the market would go dead at the price where we put the trade on, we didn't get out, then we would have lost money. But it's a different kind of risk. It's a different kind of trade. Might be something you might not already be thinking about, but I want to share with you one of my favorite trade structures, the back spread. And if you find this video useful, give us a like on the video, subscribe to the channel, go to marketlife.com. You can be in the trade room too for a $7 trial and check out Market Life, see if we can help you with your trading.
If you missed yesterday's video, yesterday's PM video, please make sure you go back and see that. I talked a lot about this SPY back spread. And one thing you need to be aware of, particularly if you're a guy who's been around for a while, options terminology is not super consistent. What some people call a back spread is basically a spread that has open-ended risk, is what we would call a front spread. But this terminology, so what a back spread is, you can see the position here. We are long more puts than we are short. And this is our model $5,000 account. So we're looking really to risk $200 or $300 a trade, and the max risk on this trade, I think there's a couple good lessons here. The max risk is $1,500. Now, you might say, that's more than 500, right? That's certainly more than 200 or 300. Yes, it is. But you think about the way you lose on this, and this. Look at this. We always talk about the purple line, but look at the blue line for a moment. This is the P&L at expiration. These spreads have a really attractive payoff profile, meaning that let's look at, just to make sure we're being consistent. So if the bears really lose on the SPY and like everything's okay with the virus, could the SPY close at 335 today or tomorrow? It could. Okay, it's possible. And if you are short, that is a very bad outcome. However, if you have on this spread, you see a close. I'll put the cursor here and then look in the bottom left-hand corner of the screen, these changing numbers that shows you the P&L. It's basically break even. The trade was set up for break even, and then we the $14 you see there's basically slippage on execution. So to the upside, where like you're really dramatically wrong on the trade, you don't get hurt. The other beautiful thing about this, if people panic, and they might, right? If people panic, look what happens as we start. So each of these lines is effectively the VIX up 10 points. But my point is, if people panic, is it possible to see the VIX go up 40 points from where 40, when I say points, I mean percentage points on the VIX? Yes, it absolutely is. And is it possible? So this is not exactly right because this is SPY implied volatility, but just look at these percentage numbers here. This would be the equivalent P&L with the VIX at these different levels. So like the theoretical P&L for this spread if SPY goes down to 285 is $2,000 ish, but realistically what's going to happen is the VIX is going to be a lot higher, and that's going to push the P&L way up. So you have an asymmetrical payoff, but you do need to think about cost. And the cost with this spread is, what do you think it is? We're long more options than we are short. So the cost of this spread is time decay. And again, we're modeling this in a $5,000 account. So that's your reference point. Your time decay is about $25 a day. That's a lot. Most of the spreads we put on, we actually manage to either get paid a little bit for time, or we're paying $3 or $4 a day for an entire trade structure. 25 is a lot, and what that tells you is this is a quantitative way to say, oh look, I can show you this. This is a quantitative way to show you that as we sit here, the P&L sags. See this? Now these lines are going forward in time. And as we sit here, the P&L is going to sag more toward this. So I ask myself, if you put on a trade here and it just sits here, that's how we end up being wrong. That's how we end up being wrong and getting hurt. Would I want to hold this with the market just sitting here? Absolutely not. So the market has to move in a few days. I'll pay the time decay on it. But I do think that most of your trading is a directional options trader. If you're trading direction, I think first of all, the right way to do that is with buying premium rather than selling.
Thank you. So I hope that was useful. As I said, if you like the video, do give us a like on the video, subscribe to the channel, and go to marketlife.com. We'd love to have you sign up for a trial, join us in the trade room, see what our tools can do for you.